When it comes to trading crypto, there's no shortage of technical indicators and price patterns you can leverage to maximize your returns. Support and resistance, bull flags, Bollinger Bands, and moving averages are a few of these common crypto trading tools. The problem is that when everyone is using the same indicators, institutional investors often anticipate what everyone else is likely to do and take profits ahead of time. This means that if you really want to get an edge over the institutions in the crypto market, you must go beyond basic technical analysis. One of the easiest ways to do this is to use on-chain analysis, and one of the most powerful on-chain signals is whale movements. Not many people know how to use this signal effectively, and that's why today I'm going to tell you everything you need to know about whale movements and how you can use them to minimize your pain and maximize your gain. Before we go for a swim, there's a disclaimer I need to pin. If you're here hoping to get some investment help, I'm afraid you'll have to find it yourself. Everything in this video is solely for your entertainment and education, so don't go crazy with your expectations. If this is your first time touching base with the Coin Bureau, my name is Guy, and this channel is ground zero for everything crypto. Coins, tokens, news, reviews, exchanges, tutorials, and market moves. The highest quality crypto content you'll find on the tube. If this sort of stuff gives you a dopamine hit, subscribe to the channel and give that notification bell a click. If you're short on time, you can use the timestamps below to skip to any topics that you can't wait to know. Just remember, watching the whole way through will help this video find its way to others like you. So, without further ado, let's take a look at what whale movements can do. To understand whale movements, you need to be familiar with on-chain analysis, so here's a quick crash course. As you know, most cryptocurrency blockchains are publicly viewable. That means that anyone can see most crypto transactions happening in real time, and this can easily be done using a blockchain explorer. What's cool is that this level of transparency lets you do much more than just verify whether your transaction went through or not. Most blockchain explorers make it possible to rank wallet addresses based on how much of that crypto coin or token they hold. Some, like etherscan.io, do this by default. Now, this is extremely useful because it can show you whether the supply of that coin or token is evenly distributed among its holders, or whether there are just a few wallets holding most of the supply. If the supply of a coin or token is heavily concentrated among a few wallets, there's a big risk that one of those wallet holders could start to sell, and this would crash the price of that coin or token. Blockchain explorers can even help you figure what people are doing with their cryptocurrency. Most blockchain explorers will label wallets belonging to centralized and decentralized exchanges. This can give you a sense of whether people are trading or holding those coins or tokens. If a significant amount of a cryptocurrency's supply is sitting on exchanges, it's likely that the people who hold that cryptocurrency aren't looking to do so for the long term. If you can see that most of a cryptocurrency supply is being held off an exchange, this suggests that the people who hold that crypto don't plan on selling it anytime soon. Now, some clever crypto traders have even gone as far as tracking down crypto wallets belonging to rich individuals and institutions. This makes it possible to mimic the buying and selling behavior of smart money, and sometimes makes it possible to spot and buy a hot 100x altcoin before it even makes the news. These more elaborate on-chain tactics are much harder to do manually, and that's why companies like Glassnode and CryptoQuant exist. On-chain analytics platforms combine price with on-chain data to create new indicators that often give you a much clearer view of the crypto market than technical analysis indicators and price patterns. For example, Glassnode's hodl wave indicator shows you how much of Bitcoin's supply has moved over a given time period. When those darker hodl waves start to peak, it means people are starting to sell. As you can see, the tip of those peaks corresponds quite nicely to previous bull market tops. The only problem is that most of these advanced on-chain indicators cost thousands of dollars to use. Some of them even cost tens of thousands of dollars per year. The good news is, that many of the free on-chain metrics are just as good if you know how to use them correctly, and this includes whale movements. In a sentence, a whale movement is a large cryptocurrency transaction. Insert your own joke about Moby Dick using the bathroom here. It's a simple signal that can have a colossal effect on the price of a cryptocurrency depending on where that transaction is going. When you see a cryptocurrency is being sent from a regular wallet to an exchange wallet on a blockchain explorer, this means the person who sent that cryptocurrency probably wants to sell it. This isn't a big deal when the transaction is small, but if you see hundreds of millions of dollars of a cryptocurrency being sent from a wallet to an exchange, that amount of sell pressure could crash the price. Conversely, if you see that hundreds of millions of dollars of a cryptocurrency is being sent from an exchange and into a wallet, whoever's behind that wallet is not planning on selling anytime soon. If there are enough whale movements off exchanges and into wallets for a specific cryptocurrency, this sudden reduction in market-ready supply can be rocket fuel for positive price action. The effects are reversed for these two whale movements when they involve stablecoins. If hundreds of millions of USDT or USDC are moving from a wallet to an exchange, this means that whales are looking to buy, and that could mean the market is about to pump. If hundreds of millions of stablecoins are moving off exchanges, this means that whales don't plan on investing anytime soon, and that could mean a temporary downturn or even a full-on bear market. If you're wondering what those exchange-to-exchange whale movements are all about, the answer is arbitrage. In other words, a whale is taking advantage of a small difference in price between two exchanges, and because they have so much capital, that small difference offers a sizable return in dollar terms. The last type of whale movement is wallet-to-wallet transactions, and these are probably the most misunderstood of the bunch. Believe it or not, most large investors don't use cryptocurrency exchanges. This is because the large amount of crypto they're looking to buy or sell could stir up the market in the ways I just mentioned. Instead, they do over-the-counter trading, or OTC. OTC allows big investors to buy or sell large amounts of cryptocurrency directly from an exchange or crypto custodian at a fixed price. When you're seeing hundreds of millions of dollars of cryptocurrency going between wallets, it's probably an OTC trade of some kind. The thing is that you can never know for sure whether it was a purchase or a sale until after the fact. Now, this is why Tesla's purchase of Bitcoin didn't affect the price of BTC until they publicly announced it. So what this means is that you don't have to pay too much attention to wallet-to-wallet whale movements, since they typically have a negligible effect on price. Now, in theory, the transaction dynamics I just mentioned are all you need to know about whale movements, and some of you might be familiar with everything I've said up to this point. The thing is, there are a few factors that can turn whale movements into a misleading signal, and these are often overlooked by the average crypto trader. The first factor relates to definition. How large does a cryptocurrency transaction have to be for it to be classified as a whale movement? Well, the answer changes depending on which whale tracking tool you're using. For example, Whale Alert seems to report every transaction on 13 blockchains that exceeds $1 million in its Twitter feed. This arbitrary threshold can be a huge problem when it comes to measuring how much of an impact a whale movement could have on the price of a cryptocurrency. This is because of market depth. Market depth tells you how much money is required to push the price of a cryptocurrency up or down on any given cryptocurrency exchange. This can easily be checked on CoinGecko or CoinMarketCap under the Markets tab. The more money it takes to push up or push down the price by 2%, the greater the market depth that crypto has. Here's why that's relevant. If you see $10 million worth of Bitcoin being transferred from a wallet to an exchange with a market depth of $20 or $30 million to the downside, even if all that Bitcoin is sold immediately, it will have a negligible effect on price. However, most altcoins have market depths in the millions and sometimes less. This means a whale movement of that size would decimate the price of that altcoin, as it would bleed the order books dry. What's more is that sometimes an altcoin's whale movement is so small in dollar terms that it's not even picked up by whale tracking tools. Even then, it could still be enough to crash the price. As such, it's important to take note of the market depth for a cryptocurrency when you're trying to determine what effect a whale movement will actually have on its price, and not immediately assume that the sky is falling or that we're going to the moon whenever Whale Alert makes a tweet. This brings me to the second factor that's often forgotten about whale movements, and that's that not all whale movements are created equal. Because most altcoins are heavily correlated to Bitcoin, a Bitcoin whale movement could crush your favorite alt even though there was no significant whale activity taking place on that altcoin's blockchain. Moreover, as we approach the peak of this bull market, certain whale transactions will become more important than others. Here's what I mean by that. On any given day, we see a few dozen whale movements for cryptocurrencies like Bitcoin and Ethereum. Some of these are large, a few of them are massive, and they have a predictable effect on price. What you don't see every day is an old Bitcoin wallet making a transaction for the first time in a very long while. Transactions from these dormant Bitcoin wallets can seriously shake up the market, and that's because they suggest that prices have risen high enough that even the most hardcore hodlers want to sell. Usually, these ancient whale movements make the crypto news and are sometimes noted by whale trackers as well. Luckily, most of these have been small wallet-to-wallet transactions in recent months. However, if we start to approach that 100k or 200k mark, and you start to see some of these old wallets start to move a bunch of their Bitcoin onto exchanges, it might mean we are at or near the top in terms of price for this cycle. It's also important to remember that the significance of a whale transaction depends on the tokenomics of the cryptocurrency and which whale wallet the transaction is coming from. There's a difference between the largest Dogecoin holder dumping 10 million Doge and a smaller Dogecoin wallet doing the same. If large whale transactions from a wallet to an exchange are consistently coming from the largest holder of a cryptocurrency that's inequitably distributed, it might be time to abandon ship. The same rule applies to transactions made from cryptocurrency wallets belonging to famous crypto billionaires like Vitalik Buterin. Vitalik is known for selling a substantial chunk of his Ethereum near the peak of the previous bull market. Now, unlike most crypto billionaires, Vitalik has made his wallet address public, but unfortunately, the transactions he's making are apparently not being tracked by free whale tracking tools. What this means is that if you hold ETH and you're wanting to get a sell signal from the V-God himself, you'll have to keep a close eye on his wallet address. I'll leave a link to it in the video description. Now, on that note, you should take the time to identify wallets belonging to any significant individuals or teams working on your favorite cryptocurrency projects. When you see that they're starting to move significant amounts of their coins or tokens to an exchange to sell, you might want to consider doing the same. The caveat here is that sometimes it can be hard to tell if the crypto they're moving is actually heading for an exchange, and some project founders even go out of their way to mask their selling behavior. That's why you should always ask questions before jumping to conclusions, and this is where most people fail when they try referencing whale movements to trade. The third factor that flies out the window when analyzing whale movements is the understanding that smart money knows how the average retail trader is likely to react to certain whale movements. The most salient example of this is whenever a large amount of stablecoins is minted. Logically, this new supply of USDT means Bitcoin is going to pump, right? Well, not exactly. As I mentioned in my video about stablecoin market manipulation, stablecoins are minted and burned based on market demand. Now, this is necessary because if there's too much or too little USDT compared to demand, this could push the price of USDT off its dollar peg to the upside or downside. The main takeaway here is that the printing of USDT or USDC doesn't automatically mean prices are going to increase. It just means that the demand for those stablecoins has increased. After all, if a big investor is buying Bitcoin, they're probably not going to mint a bunch of stablecoins to do it. They'll just use an OTC desk. Anyways, these facts fall on deaf ears to the average whale watcher who wrongly assumes that the minting of stablecoins means we're about to see a mega pump. This makes them privy to manipulation by big investors who could push up the price by a couple of percentage points following the stablecoin print to give the illusion that something is happening. Retail investors FOMO into the pump and get dumped on by the smart money. The same thing happens when it comes to whale movements on and off exchanges. Without the context of the first two factors I mentioned earlier, reacting to the naked implications of these large transactions is a great way to get wrecked by big investors. Understanding that the smart money is aware of the ways the average crypto trader reacts is the basis of the Wyckoff method, which I explained in depth in a recent video. You'd be wise to factor Wyckoff into your whale watching activities, and you can find my video about it using the link in the top right. On-chain analysis is something that I've had the luxury of exploring to the fullest extent. As someone who's tried both paid and unpaid on-chain indicators and signals, I can tell you that you can get a pretty good bang without having to put down a buck. The primary difference between the free and paid versions of most on-chain metrics is that the paid versions are more refined and give you more options when it comes to sifting through the data. When it comes to whale movements, what you get from using free tools like Whale Alert and lookintobitcoin.com are more or less the same as what you'd find on Glassnode and CryptoQuant. However, an indicator is only as good as the trader who's using it, and it seems that the average crypto trader doesn't know too much about whale movements or how to use them. Now, I reckon this has to do with the fact that there is no universal definition for what counts as a whale movement in cryptocurrency. In my mind, a whale movement is any transaction that's large enough to disrupt the price of a cryptocurrency. Everything else is just noise. It's also easy to forget that whale movements and whales might be mutually exclusive because of this definition. That might sound strange, but it conveniently helps underscore the importance of knowing which wallet a whale transaction is coming from. I remember that I checked Vitalik's wallet address shortly after the crash in mid-May and saw that almost all his Ethereum was gone. That was a bit of a scare, but it turns out that he'd just moved most of his ETH into cold storage. This is the wallet address that's in the description, by the way. Now, sometimes I wonder if these crypto billionaires ever play chicken with the average crypto investor by moving large amounts of crypto on and off exchanges without buying or selling. Maybe they even do this in tandem with specific news or events because they know it will inspire some strong feelings from the average retail investor. If analyzing the Wyckoff method has taught me anything, it's that you're better off assuming that the smart money is always looking for opportunities to mess with your head. Keeping that in mind can go a long way, but make no mistake, if you see that dozens of whale transactions are making their way to crypto exchanges in tandem, it might be for real this time. If you enjoyed today's whale watching expedition, feel free to drop me a like. Be sure to subscribe to the channel and ping that notification bell too if you haven't already. I've got boatloads of crypto content in the works, and you can see me make it in real time by following me on Twitter, TikTok, and Instagram. If the crypto market has got you crazy, join my free Telegram channel to get detailed updates on the daily. The only thing better is my weekly newsletter, which is where I give you the keys to my personal crypto kingdom, revealing my portfolio and giving you the tools, tips, and tricks to stay in the know. If you want to support the channel while looking like a crypto king or queen, head on over to the Coin Bureau merch store and pick out the shirts and hoodies that match your scene. You can find the links to all these resources in the video description. As always, thank you for watching, and I will see you in one Earth rotation.